Currently, credit card delinquencies in the United States have reached levels comparable to those seen in 2008, as per a recent Federal Reserve survey. Notably, total credit card debt in the country has surpassed $1 trillion for the first time, marking a significant milestone. The rates of credit card delinquencies have exceeded pre-pandemic levels, a trend worth considering in light of prior assurances of a soft landing by economic figures such as Janet Yellen in 2007 and Jerome Powell more recently. In a world of financial uncertainties, a measured approach is crucial. Today, we discuss the realities of the 2024 economic landscape, placing particular emphasis on the alarming surge in credit card debt. Please make sure to subscribe and leave us a like below this video. What's particularly noteworthy is that 1 in 5 Americans is utilizing buy now, pay later options to finance everyday expenses, including groceries. This means that a substantial portion of the population is resorting to installment loans for items like bread, steak, eggs, milk, and chicken. This raises questions about the overall health of the economy and whether we may be heading towards a potential financial challenge. Looking ahead, there is a prediction of a significant wealth transfer in the coming years, with many Americans possibly compelled to liquidate assets such as homes and cars, or even close down businesses. The changing economic landscape is expected to create opportunities for some individuals to amass wealth, while others may face challenges due to a lack of awareness of the evolving circumstances. Examining the economic landscape, household debt is currently at an all-time high, reminiscent of the 2008 financial crisis. This includes not only credit cards but also auto loan defaults. Although there is presently substantial equity in homes, the dynamics may shift as economic conditions change. The potential for more layoffs and economic shifts could lead to a scenario where many Americans find themselves in the position of selling off their homes. The significant question arising is how many Americans can afford to buy homes when the cost is 60% higher than renting. In such a scenario, it becomes a race to find buyers, especially if there are more sellers than buyers. As the imbalance grows, buyers gain increased control over the market, leading to what seems like an imminent affordability crisis. Both home buyers and sellers are contributing to this, with sellers holding perceived equity that might not materialize when cashing in. Adding to the economic concerns, credit card delinquency rates have surged to a decade high. Approximately 40% of Americans have missed their student loan payments, totaling around 9 million individuals. Tracking these issues since January 2nd, when late payments started accumulating, indicates a potential rise in delinquencies. With the ongoing holiday season, where people tend to spend more, there is a possibility that more individuals will fall behind on bills. Examining credit card balances, which reached $1 trillion for the first time this year, the share of credit card debt falling behind has climbed from 6.5% in the first quarter of 2023 to 8% in the third quarter. This 8% rate is the highest in more than a decade. Looking specifically at subprime borrowers, credit card delinquencies are expected to climb to 9.2% in the first half of 2023, approaching the default rate of payday loans, which is considered riskier for lenders. Predicting a decrease to 9% by the end of the year is contingent on a significant improvement in the job market, which may face challenges given the looming refinancing of $1 trillion in corporate debt and the potential for a tougher job market compared to recent years. If inflation worsens and consumer credit card debt becomes more challenging to manage due to soaring interest rates, especially with a Fed funds rate reaching 5.25% to 5.5%, the likelihood of delinquencies falling seems slim. In fact, there's a belief that delinquencies may either persist at around 9.5% or potentially increase. An interesting development is the Consumer Financial Protection Bureau, CFPB, signaling its intent to pursue credit card companies, particularly regarding their late fees. This move, initiated about 3 weeks ago, is portrayed as the CFPB ending a credit card late fee frenzy, potentially saving Americans significant amounts. Considering the impact of reduced late fees on credit card companies, where fees might go from $41 to $8, representing a 75% reduction, and observing a surge in defaults to 9% or 9.5%, credit card companies may become more cautious. With approximately 1 out of 10 consumers not paying back, the scenario prompts a reconsideration of lending practices. The trend of widespread borrowing over the past few years may now face a shift, as lenders become more discerning in extending credit. An illustrative figure is the 70 million credit card accounts opened in the U.S. since pre-pandemic 2019. The prevalence of credit card usage, coupled with an average debt of $6,000, makes credit card debt the most common form of household debt for Americans. A 2023 Banker report reveals that 47% of credit card holders struggle to pay off their monthly balances, leading them to roll over credit card balances from month to month, incurring substantial interest and fees. The gravity of the situation is underscored by the exorbitant credit card interest rates, with some retail rates reaching 33%. For instance, if someone carries a $15,000 balance on a credit card with a 33% APR and pays $450 a month, they would end up paying $26,000 in interest over 7 years and 8 months. This underscores the urgency of addressing the soaring credit card interest rates, especially when the average interest rate stands at 24.25%. With an average interest rate of 24.25%, making a monthly payment of $350 would result in approximately $20,000 in interest over 8 years and 5 months to pay off the debt. It's common for many Americans to overlook their monthly payments, opting for minimum payments and procrastinating on addressing their financial situation. Over time, this approach often leads to finding oneself in a similar or worse financial state, having missed opportunities to invest in education, business, or other essential aspects of life, such as paying off a car. Taking a strategic and proactive approach is crucial in the current economic landscape, where the middle class is facing erosion and wealth inequality is on the rise. It's essential to adopt a mindset similar to how wealthy individuals manage their finances. Building relationships with different banks and credit card companies, applying for cards within one's approval range, and using credit responsibly are key steps. For instance, using a single card for specific expenses, paying it off entirely each month, or transferring high-interest consumer credit card debt to a 0% APR card can be effective strategies. Maintaining a good credit score is vital for accessing favorable credit options. Playing defense by tightening spending, eliminating unnecessary expenses, and building relationships with multiple lenders positions individuals to navigate potential changes in lending practices. In the face of economic shifts, being prepared with stable income, cash reserves, and the ability to secure funding puts one in a favorable position. Drawing parallels to the financial crisis of 2008 to 2010, those with the means to acquire assets during uncertain times are poised for success. It's essential to recognize that even a single late payment can significantly impact your credit score, leading to a drop of up to 180 points, lingering on your report for 7 years. This can hinder your ability to secure loans and financial opportunities. Taking proactive steps to address and improve your credit score is key to positioning yourself for better financial outcomes.